My name is Michael Grandy. I'm a professor at Providence College. This semester I'm teaching an MBA class, the title of which is Making Business Decisions. We're using the managerial accounting text, which is the Garrison, Noreen, and Brewer textbook, titled Managerial Accounting 7th edition. And we're going to be talking about Chapter 5, specifically focusing on cost, volume, profit relationships. We're going to be talking about how to construct the CVP income statement, also known as the contribution format income statement. We're also going to be talking about how to calculate break-even point in units and in sales dollars. We will not be using the equation method. We'll be using the formula method. So when we see some slides on equation, I'm going to skip over those. We're also going to skip some slides between 77 and 93. That's not material I want to hold you responsible for, but we'll pick up when it gets to sales mix, sale of multiple products, beginning at slide 94. So let me share my screen with you. We will pick up the PowerPoint presentation. And again, this is cost, volume, profit, chapter 5. So cost, volume, profit analysis. To simplify cost, volume, profit calculation, managers typically adopt the following assumptions with respect to these factors. The sales price is constant. The price of a product or service will not change as volume changes. Secondly, costs are linear and can be accurately divided into variable and fixed components. The variable costs are constant per unit, and fixed costs are constant in total over the entire relevant range. And we saw some of those definitions in the first chapter. Number 3, in a multi-product companies, the mix of products sold remains constant. So let's first talk about explaining how changes in sales volume affect contribution margin and net income. So here's an example that we'll be working with. It's different than the one in the textbook, but it's still a very good analysis. The contribution income statement is helpful to managers in judging the impact of profits, of changes in selling price, cost, or volume. The emphasis is on cost behavior. So you can see the contribution format income statement that begins with sales. We subtract variable costs, end up with contribution margin, subtract our fixed cost, end up with net income. Contribution margin is the amount remaining from sales revenue after variable expenses have been deducted. Contribution margin is used first to cover fixed expenses, and any remaining contribution margin contributes to net income. Sales, variable expenses, and contribution margin can also be expressed on a per unit basis. And we're going to see it can also be expressed on a percentage basis. So you're going to see it in total dollars. You'll see it on a per unit basis and as a percentage. The sales number is always the 100% amount. If racing sells an additional bicycle, $200 of additional contribution margin can be generated to cover fixed expenses and profit. As you can see here on a total dollar basis, but on a per unit basis, the selling price per unit is $500. Because they're selling 500 bicycles, the total revenue is $250,000. Quantity times price. Number of units, 500 bicycles. Price, $500 per unit. Sales revenue, $250,000. Similarly, the variable cost per unit is $300 per unit. And how do you get the variable expenses? Well, again, it's quantity times price. So if you're going to sell 500 bicycles, the variable expenses also need to be based on 500 bicycles. So quantity times price. 500 bicycles times a variable cost per unit of $300, you got $150,000 in total variable expenses. And the relationship continues with regard to contribution margin, quantity times price. 500 bicycles at $200 per bicycle is the contribution margin. Got $100,000 of contribution margin. The fixed expenses, as you know, by definition, the fixed expenses stay the same regardless of sales volume. In this case, $80,000. They have net operating income of $20,000. Each month, RBC must generate at least $80,000 in total contribution margin to break even, which is the level of sales at which profit is zero. If RBC sells 400 units in a month, it will be operating at break-even point. Well, how do I know that? Well, we're going to see some formulas. You can also try trial and error, but you can very easily see that if the contribution margin per unit is $200 and the fixed cost is $80,000, they need to sell 400 bikes to cover their fixed expenses and have a net income of zero. Break-even point. Break-even point, by definition, is that level of sales where sales equals all expenses, where sales equals variable expenses plus fixed expenses, resulting in a net income of zero. If RBC sells one more bike, 401 bikes, net operating increase will increase by $200. That is the contribution margin on one bicycle. We do not need to prepare an income statement to estimate profits at a particular sales level. Simply multiply the number of units sold above break-even point by the contribution margin per unit. If RBC sells 430 bikes, it needs its net operating income will be $6,000. The 30 units above break-even point, right, 430 minus 400, multiplied times the contribution margin per unit of $200. Net income is $6,000. The contribution format income statement can be expressed in the following equation. So I don't want to use the equation method. I want to work with the formula method. So we're going to skip ahead a little bit. Prepare and interpret the cost, volume, profit graph. In the profit graph, again, I don't want to use the graph method. I want to use the contribution margin ratio. So use the contribution margin ratio to compute changes in contribution margin and net income resulting from changes in sales volume. So the contribution margin ratio in the variable expense ratio. The contribution margin as a percentage of sales is referred to as the contribution margin ratio. And you can see that it's the contribution margin, which is sales minus the variable cost per unit divided by sales. That's the contribution margin percentage. So for RBC, the contribution margin ratio was calculated as follows. Contribution margin of $80,000 divided by sales of $200,000. The contribution margin percentage is 40%. For each $1 increase in sales results in a total contribution margin increase of 40 cents. Contribution margin ratio can also be calculated by dividing the contribution margin per unit by the selling price per unit. So you can do it on a total dollar amount, and you can also do it on a per unit basis. Should equal exactly the same thing, 40%. The variable expenses as a percentage of sales is referred to as the variable expense ratio. This ratio is computed as follows. The variable expenses divided by sales. And again, you can do this on a total dollar amount And you can do it on a per unit basis. It's going to be 60%. Another way to calculate it is that the sales number is always the 100% number. And the variable expense ratio plus the contribution margin ratio must always equal 100%. So if you know one of them, if you know two of those numbers, the 100% number and the variable expense ratio, you can conclude with the contribution margin percentage. Having defined the two terms, it bears emphasizing that the contribution margin ratio and the variable expense ratio can be mathematically related to one another. Like I said, the contribution margin percentage plus the variable percent must always equal 100%. If RBC increases sales from 400 to 500 bikes, that's a $50,000 increase, right? The sales price was $500. The number of units is 100, so you have an increase in sales of $50,000. Contribution margin will increase by $20,000. That's the 40%, right? Because if the sales go up, if the sales go up by $50,000, 40% of the $50,000 is $20,000. There's your increase. Quick check. Coffee Klatch is an espresso stand in downtown office building. The average selling price of a cup of coffee is $1.49. And the average variable expense per cup is 36 cents. The average fixed expense per month is $1,300. An average of 2,100 cups are sold each month. What is the contribution margin ratio for Coffee Klatch? So the unit contribution margin is the sales price per unit at $1.49, less the variable cost of 36 cents. Contribution margin per unit is $1.13, divided by the sales price of $1.49. The contribution margin ratio, the percentage, is 75.8%. The relationship between profit and contribution margin ratio can be expressed using the following equation. Profit equals contribution margin ratio times sales minus fixed expenses. Show the effects on net operating income of changes in variable cost, fixed cost, and selling price and sales volume. Change in fixed cost and sales volume. What is the profit? What's the profit impact if RBC can increase unit sales from 500 to 540 by increasing the monthly advertising budget by $10,000? So you can see they have done a contribution format income statement at the 500 unit level and at the 540 unit level. So sales are going to go up. Sales increase by $20,000, right? Which is the 40 units multiplied times $500 per unit is $20,000. But you also need to make sure that you increase the variable expenses. The variable expenses also have to go up because they're selling 40 more units, and the variable cost percentage is 300, the variable cost dollars is $300. So 40 units times $300 a unit is $12,000. That's the increase in variable expenses from 150 to 162. But we also said what? That they're going to add $10,000 to the advertising budget, which is a fixed cost. So it goes from $80,000 to $90,000. The net operating income goes down by $2,000. A shortcut solution would have been as follows. there was an increase in contribution margin, right? There was an increase of 40 units. The contribution margin per unit is $200, so the contribution margin goes up by $8,000. Fixed costs go up by $10,000. You can see there's a decrease in net income of $2,000. Here's another example. What if we have a change in variable costs and sales volume? What is the profit impact if RBC can use higher quality raw materials, thus increasing variable cost per unit by $10 to generate an increase in unit sales from 500 to 580? So let's think about this for a minute. Sales volume goes up by 80 units. So revenue is going to go up by 80 units times $500 a unit. But the contribution margin is also going to go up, right? Because the contribution margin is going to go up by 80 units times $200 per unit. But not really, because what happens here? They're going to increase the variable costs per unit by $10. So the contribution margin per unit goes down. So you can see the revenue goes up. It goes up by 80 units times $500. Sales revenue goes up by $40,000. But variable expenses go up as well, right? 580 units times 310. The variable cost per unit was 300. They added $10 to it. So the total variable cost goes up to 179.8. Contribution margin is now 110, 200. Fixed cost is no impact on the change. Profit goes up. What is the profit impact if RBC cuts its selling price by $20 per unit, increases its advertising budget by $15,000 per month, and increases sales from 500 to 650 units per month? You can see that we have the additional units, 650 units times $480 a unit, because it did what? It cut the sales price by $20 per unit. So it's no longer $500 a unit. The variable expenses, was there a change in the variable expenses? No, no change in the variable expenses. So the variable expenses are going to be 650 units times $300 a unit for $195,000. Fixed expenses goes up by $15,000 because they said what? They're going to increase the advertising budget by $15,000 per month. Fixed expenses are now $95,000. Profit goes up by $2,000. What is the profit impact if RBC does one? Pays a $15 sales commission per bike sold instead of paying salespersons a flat salary that currently total $6,000 per month, and increase the sales from 500 to 575 bikes. So what's happening here in this first item? They're converting the cost. They're shifting what? They're increasing the variable cost per unit, but they're dropping their fixed cost. And they think they're going to sell more bikes because commission salespeople tend to work hard. So they have sales are now 575 bikes, a 75 bike increase at the $500 sales price. But the variable expenses, right, still based on 575 units, but the variable cost goes from 300 to 315 because there's a $15 per bike commission. And fixed expenses go down, right, because they're going to shift the salaries. Instead of paying a flat salary, they pay them a commission. So fixed expenses goes down, net income goes up. If RBC has an opportunity to sell 150 bikes to a wholesaler without disturbing sales and to other customers or fixed expenses, what price would it quote to the wholesaler if it wants to increase monthly profits by $3,000. So you say the variable expenses, right? So the total variable expenses are $45,000, right? So if they want to sell, right, they're telling you, right, 150 bikes. Got 150 bikes. The variable expense is 150 bikes times $300 a bike is $45,000. They want to make $3,000. That means that they have to have a sales price of $3,000 greater than the variable expenses, which is going to be $20 per bike. 20 bikes times 150 bikes is $3,000. Determine the break-even point. Now, again, we want to focus on the formula method and not the equation method. The equation and formula methods can be used to determine the unit sales and dollar sales needed to achieve target profit of 0. Right? That's what break-even point is, target profit of 0. Let's use the RBC information to complete the break-even point. So, as I mentioned earlier, we can look at the contribution format income statement, total dollars, per unit basis, and a percentage. Please note that the sales number is always the 100% number. And this is where they are right now. This is not break even. This is where they have profit of $20,000. This is the equation method. I don't want to talk about it. Let's look at the formula method. The formula method is a shortcut version of the equation method. It centers on the idea discussed earlier in the chapter that each unit sold provides a certain amount of contribution margin that goes towards covering fixed expenses. So this is an important formula to remember. Break-even point in units, BEP units, equals this formula. Fixed expenses divided by the contribution margin per unit. And this is the given fact pattern we've been working with. Fixed costs were $80,000. The contribution margin per unit is $200. Sales price $500 minus variable expenses of $300. Contribution margin per unit is $200. Therefore, they need to sell 400 units to break even. Also remember, 400 units times $200 of contribution margin per unit equals $80,000, which is the fixed cost. Suppose RBC wants to compute the sales dollars required to break even, earn a target profit of 0. Let's use the equation method and the formula methods to solve this problem. Again, we're going to skip the equation method. Using the formula method, break-even point in sales dollars, BEP sales dollars, equals fixed expenses divided by the contribution margin percentage. $80,000 divided by 0.40 is $200,000. So what that's saying is when sales revenue, total sales revenue, is $200,000, net income will be 0. So let's remember, we calculated break-even point in units. Break-even point in units was 400 units times $500 a bike, $200,000 in sales. Coffee Klatch's an espresso, has an espresso stand in downtown office building. The average selling price of the cup of coffee is $1.49. The average fixed expense per month is $1,300. An average of $2,100. We've seen the example, right? What is the break-even point in sales dollars? So it's the fixed expenses divided by the CM ratio. When they have sales revenue of $1,715, their break-even is 0. Their target profit is 0. Coffee Klatch is, in as I say, same scenario, right? Selling price $1.49. Variable expenses 36 cents. Fixed cost $1,300. They sell an average of 2,100 cups. What's the break-even point in sales units? Now, you remember the formula. break-even point in units, fixed cost, divided by the contribution margin per unit. $1,300 divided by the contribution margin per unit. They need to sell 1,150 cups of coffee to break even, to cover their fixed costs. Determine a level of sales needed to achieve desired target profit. So target profit and break-even point formulas are very similar to each other. The only difference is that in break-even point, the target profit is 0. So what we're going to do to calculate target profit is we're just going to add the target profit to the fixed cost to calculate these numbers. We're going to use the formula method. Unit sales to attain the target profit, right? Target profit plus fixed expenses equal divided by CM per unit. So on break-even point, the target profit is 0. That's all. It's very similar formula. Same thing. If you want to have $100,000 in profit, you add the $100,000, they need to sell 900 bikes. You can also compute the target profit in terms of sales dollars using both methods. Gives me total dollars. Coffee Clutch Espresso, you know the story, right? Selling price $1.49. Variable expenses 36 cents. Use the formula method. How many cups of coffee to have a target profit of 2,500? So you just add the target profit to the fixed costs. Yeah, the same thing, right? You add the target profit to the fixed costs. Compute the margin of safety. Explain its significance. The margin of safety is the excess of budgeted or actual sales dollars over the break-even point in sales dollars. It is the amount by which sales can drop before losses are incurred. The higher the margin of safety, the lower the risk of not breaking even or incurring a loss. Margin of safety in dollars equals total sales minus break-even sales. So in our scenario, right, where they're selling 500 units, they've got total sales of $250,000. You calculated their break-even to be $200,000 in sales. They have a margin of safety of $50,000. It's that simple. Margin of safety, stated as a percentage, is the excess, is the margin of safety in dollars divided by the actual sales. In this case, 20%. Margin of safety can be expressed in terms of the number of units sold. So you know the margin of safety in dollars. You know the sales price per unit represents 100 bikes. Again, going back to Coffee Clutch, you know the facts. What is the margin of safety expressed in cups? So they're selling 2,100 cups. You calculated previously that the break-even point in cups was 1150. They have a margin of safety of 950 cups. And I think we're going to skip a little bit of this. Yeah, we're going to skip that. We're going to skip the degree of operating leverage as well. I want to next talk about sales mix. So let's compute the break-even point for a multi-product company. That means a company that sells multiple products, product A, product B, product C, and explain the effects of shift in the sales mix on contribution margin and break-even point. Definition of sales mix. Sales mix is the relative proportion in which a company's products are sold. Different products have different selling prices, have different cost structures, specifically variable costs, and obviously contribution margins. When a company sells more than one product, break-even analysis becomes more complex, as the following example illustrates. Let's assume that RBC sells bikes and carts, and that the sales mix between the two products remains the same. So bikes comprise 45% of RBC sales, and carts comprise 55%. Well, how do I know that? Well, look at the sales revenue for bicycles, 250,000, and the carts is 300,000 for a total of 550,000. So if you take $250,000 from bicycles divided by the total sales of 550,000, you can see the bicycles represent 45% and the carts 55%. RBC provides the following information. Now, the other thing that's important here is you can see that the bicycle and the carts have different variable cost percentages, resulting in different contribution margin percentages. The bicycles have a 40% contribution margin, the carts have a 55%, but on an overall basis, on a weighted average basis, the contribution margin combined is 48.2%. Is what? The total contribution margin divided by total sales. They've got 48.2% contribution margin ratio. So how do we calculate break-even point in sales dollars? Well, we take the total fixed cost, as we did before, and divide it by the combined contribution margin ratio. Come up with total sales of $352,000. Now, in order to prove this, in order to show that break-even point is 0, we need to do out this chart. And we need to keep in mind we have to use exactly the same sales mix that was used before, where the bicycles had 45% and the carts had 55%. So you can see where they took the 352 multiplied times 45%, they had sales for the bicycles of $158,000. And then you can also see that the carts, their sales mix is 55%. They get $193,000. Now, we also have to keep the variable expenses at the same ratio as they were previously. So in the bicycles, the variable expenses are 60% of sales, come up at 95,228. In the carts, the variable expenses were 45%, times 193 is 87. Sales minus variable expenses equals contribution margin. On a combined basis, 170,000. Fixed cost, 170,000. You can see there's a slight rounding error here, not to worry about. So we're going to see an example of this when we do some of our problems. And I think that's the end of the PowerPoint presentation. We'll see some more examples and talk to you later. Thank you.